The stock market? It's pure chaos right now. One day, tech stocks are flying high. The next, people are shouting, overvalued. Inflation? It's cooling. Interest rates? Still high enough to sting. Feels like the rules keep changing. And if you're stuck wondering where to invest, well, you're not alone. But there is a way to decode the chaos. Every quarter, 13F filings from billionaire hedge funds peel back the curtain on what the market's most strategic minds are doing. In today's video, I am breaking down the latest 13F filings of the smart investors out there. What's overvalued, what's under the radar, and most importantly, how can you use this knowledge to invest in the chaotic market? But first, let's set the stage. The US is walking on a tightrope, with a storm of challenges brewing on multiple fronts. On the surface, inflation appears to be cooling, but it's far from under control. Despite aggressive interest rate hikes by the Federal Reserve, prices for essentials like housing and services remain stubbornly high. The persistent inflation is eating into consumer spending power. That's the backbone of the American economy, and it makes it harder for businesses to maintain profit margins. Interest rates, now at their highest levels in decades, are adding another layer of strain. Borrowing costs for consumers and businesses have skyrocketed, slowing demand for big-ticket items like homes, cars, and capital investments. Housing in particular has become increasingly unaffordable, with mortgage rates nearing 8%, pushing many potential buyers out of the market. As a result, the real estate sector is seeing a sharp decline in activity, creating ripple effects across related industries. Corporate America isn't immune either. Earnings are under pressure as companies struggle with rising input costs, slowing demand, and an increasingly cautious consumer. Many tech giants that thrived during the low interest rate era are now grappling with sky-high valuations that are becoming harder to justify. Layoffs in tech and other industries are adding to economic uncertainty, while corporate debt has ballooned to alarming levels. Rising borrowing costs make servicing this debt even more difficult, increasing the risk of defaults and financial instability. On top of all of this, geopolitical tensions are reshaping the global economic landscape. The war in Ukraine has disrupted energy markets, and strained relations with China are adding further complications for U.S. businesses that rely on global supply chains. Meanwhile, Washington faces its own internal battles, with recurring debt ceiling standoffs and fiscal uncertainty threatening to undermine confidence in the government's ability to manage the economy. Recent market indicators are signaling potential turbulence ahead, prompting astute investors to take notice. The CBOE Volatility Index, or the VIX, often referred to as the fear gauge, has edged up from low levels, reflecting increased investor concern over economic data and market stability. Additionally, the U.S. Treasury yield curve has experienced inversions, where short-term yields surpass long-term ones, a pattern that has historically preceded economic recessions. Corporate earnings estimates have also been revised downward, with analysts making larger cuts than average to EPS estimates for S&P 500 companies for Q4, indicating potential challenges in maintaining profit margins. Furthermore, global corporate debt levels have reached significant heights, with the level of global rated corporate debt at $23.2 trillion, up 2.7% from the previous year, raising concerns about financial stability amid tightening monetary policies. The question is, what is smart money doing in this case, and what should you do about it? Let's talk about the smartest investors in the game. These are investors like Warren Buffett, Bill Ackman, Michael Burry, Howard Marks, and Manish P. They've spent decades mastering the art of investing. But what makes them so special? And most importantly, why should we care about what they're doing? Here's the deal. These investors don't just buy and sell based on headlines or trends. They piece together clues from corporate earnings reports, global market conditions, and economic data. They see the market through a lens that's far sharper than ours. When the average investor gets excited by flashy growth stocks, these folks are already asking, what's the hidden risk here? Warren Buffett, for example, he's famous for his steady hand and long-term thinking. In Q3, he made some bold moves, trimming and in some completely exiting from the stock market. Does that sound like confidence in the market to you? Or Bill Ackman, who went on a buying spree, He's playing a different game, but the strategy is unmistakable. Focus on strength during uncertainty. And then there's Michael Burry, the ultimate contrarian. He's pivoting heavily towards overseas stocks while pulling out of riskier US plays. What ties them all together is this: they're not panicking. They're not complacent either. They're positioning themselves carefully. And when all of them are shifting in unison, it's time to pay attention. Now let's dig a little deeper into what the smart investors in the game, Buffett, Ackman, Burry, Marx, and Pabrai, have been up to in Q3. As I break this down, you'll see a pattern. First, I will show you what each of these investors are selling and buying, and then I will show you a common trend between their portfolios. Let's start with Warren Buffett, the Oracle of Omaha. Buffett has always been known for his steady, calculated approach to investing, and this quarter was no exception. He reduced some of his biggest positions, most notably in Apple, where he trimmed his stake by a notable 25%. For someone who has often referred to Apple as his third business, such a move immediately raises questions. Buffett also cut back significantly on Bank of America, reducing his holdings by 22.8%, and pulled back further on NU Holdings with a 19.3% reduction. On the other hand, Buffett isn't retreating entirely. In fact, he's adding to companies he sees as fundamentally strong and resilient. He's increased his holdings in Domino's Pizza and Pool Corp, which suggests he still sees opportunities in consumer-focused sectors with steady demand. What's particularly interesting is that he completely exited his positions in SiriusXM and Floor & Decor Holdings. When Buffett walks away from the company entirely, it's often a clear signal that he no longer believes in its long-term growth potential. These moves reflect a classic Buffett strategy, trimming positions in sectors he feels have peaked while doubling down on areas he deems undervalued or resilient. His biggest bet? Financials, which makes up 37.83% of his holdings. Why? Buffett trusts the stability of banks and insurance companies to deliver steady returns over time. Next up is technology, taking a solid 26.6% slice of his portfolio. But it's not about chasing the latest tech trends. His investment in Apple isn't just about gadgets. He sees it as a powerhouse consumer brand with loyal customers. The recent sell-off was to secure some timely profit from the increased valuation. Then there are the consumer staples, which make up 16.16% of his portfolio. This sector includes recession-proof names like Coca-Cola, a classic Buffett favorite. Energy follows with 11.5%, thanks to reliable cash-generating companies like the Occidental Petroleum and Chevron. The rest of his portfolio, it's pretty lean. Just 3.61% in services and 2.22% in healthcare, showing his focus is on stability. Interestingly, he has almost no exposure to sectors like materials or consumer goods. And that's not an accident. It's Buffett being Buffett, zeroing in on a few key areas he knows will stand the test of time, rather than spreading himself too thin. Next up is Bill Ackman, the bold investor known for his sometimes controversial, always headline-grabbing strategies. In Q3, he made some eye-catching moves that reflect his confidence in long-term growth, even with today's market uncertainty. He went all in on Nike, increasing his position by a massive 435%. He also made a massive bet on Brookfield, adding 377% to his holdings. This means Ackman is confident in the long-term potential of these globally recognized brands, even in the face of market uncertainty. However, Ackman wasn't shy about trimming elsewhere. He reduced his stakes in Hilton Worldwide, Restaurant Brands International, and Canadian Pacific Kansas City, signaling a shift in focus towards companies with stronger consumer-facing growth potential. Ackman's Q3 activity tells a clear story. While he's not ignoring the potential for turbulence, he's selectively choosing brands he believes can weather any storm. Bill Ackman's portfolio tells a clear story. He's laser-focused on a few key areas that he believes can deliver both stability and growth. At the top of his list are services, making up 35.57% of his holdings. Right behind are financials at 24.79% and consumer discretionary at 24.31%. Amman also has a modest but strategic investment in technology at 14.89%. This gives him an exposure to innovation and growth without taking on the wild swings tech stocks can bring. On the other hand, real estate barely registers in his portfolio at just 0.44%. It's likely a reflection of his cautious approach to a sector facing significant economic risks right now. Then there's Michael Burry, the man who gained fame for predicting the 2008 housing market collapse. Burry's Q3 moves are a masterclass in contrarian investing. He made bold bets on Chinese tech companies, significantly increasing his stakes in JD.com and Baidu by 100% and 66.7% respectively. This pivot to Chinese markets is a calculated gamble, as many analysts project significant growth in this sector despite broader global economic uncertainty. Burry also added positions in Alibaba Group, Shift for Payments, and Molina Healthcare, diversifying his portfolio while showing a strong preference for high-potential growth stocks. At the same time, he completely exited his positions in Hudson Pacific Properties and BioAlta, signaling a retreat from U.S.-based companies as he sees riskier in the current environment. Michael Burry's portfolio is overwhelmingly concentrated in technology, which accounts for 65.48% of his holdings. This focus underscores his confidence in the growth potential of tech companies, particularly in emerging markets like China, where he has heavily invested in firms like JD.com and Baidu. Combined with information technology at 16%, tech-related sectors dominate over 80% of his portfolio, signaling a strategic bet on innovation and digital transformation. The healthcare sector, comprising 12.45%, provides a measure of stability as it often performs well regardless of economic cycles. Smaller allocations to consumer cyclical, which is 4.72%, and financials, 1.36%, reflect his selective diversification into industries that could benefit from economic recovery. Fourth on the list is Howard Marks, the macro-driven investor behind Oak Tree Capital, who showed his usual knack for spotting opportunities in Q3. Marx made significant additions to international and niche markets, increasing his positions in Alibaba by 83%, in Divior by an astonishing 111%, and Liberty Global by 57.12%. He also added Trip.com Group and Joy Incorporated, further diversifying his holdings across sectors and geographies. However, Marx isn't ignoring the risks in resource-heavy and financial sectors. He reduced his holdings in companies like Torm plc, Vail, Starbark Carriers, and Banco Bradesco, signaling caution towards areas vulnerable to global slowdown. Mark's strategy reflects his typical contrarian approach, pulling back where he sees risks and doubling down where he sees undervalued growth. As for sector contribution, industrials dominate at 26.42%, highlighting his confidence in sectors like manufacturing and transportation, which benefit from steady demand and economic recovery. Energy, making 13.46%, shows his interest in cash-generating assets such as oil, gas, and renewables, often resilient during inflationary periods. The materials sector, at 11.88%, further emphasizes his focus on raw materials and commodities, which act as a hedge against volatility. Consumer goods at 10.23% and financials at 9.17% reflect his preference for stable defensive industries, while technology at 7.94% and services at 6.76% indicate measured exposure to growth-oriented opportunities. Smaller allocations to utilities at 2.89%, healthcare at 2.54%, and consumer cyclical at 1.71% reveal his diversification strategy without overcommitting to volatile sectors. Finally, there's Manish P, the disciplined value investor known for his unconventional yet deeply strategic bets. Pabrai's Q3 activity was centered around the energy sector, where he made some massive moves. He significantly increased his stake in Consol Energy by 348% and added 48% to Warrior Met Coal, doubling down on companies he sees as hedges against inflation and macroeconomic uncertainty. At the same time, He trimmed his position in Arch Resources by a sharp 92%, refining his portfolio to focus on the strongest players within the energy sector. Burry's moves highlight his commitment to deep value opportunities, particularly in sectors that can weather global volatility. Manish P's portfolio is all about focus and conviction. Nearly half of it, 45.89%, is concentrated in materials. These industries are often reliable hedges against inflation and economic uncertainty, making them a cornerstone of his strategy. Energy is another major player in his portfolio, taking up 34.39%. By investing heavily in oil and gas, Burry is clearly betting on the resilience of cash-generating sectors that can weather global volatility. Financials round out 18.08% of his holdings, adding stability through investments to institutions known for consistent returns. On the other hand, his minimal 1.64% allocation to services suggests he's steering clear of consumer-facing businesses that might struggle during these market fluctuations. One of the clearest trends is a shift towards defensive sectors. From Buffett's increase in consumer-focused staples like Domino's Pizza to Howard Marks' investments in industrials and energy, there's a common belief that resilience matters more than high-risk growth right now. Even Bill Ackman's focus on globally recognized brands like Nike and Brookfield reflects a preference for businesses that can weather economic turbulence. Energy and commodities feature heavily across multiple portfolios, with Burry, Marx, and Buffett all making significant allocations to these sectors. Why? These are industries that don't just survive during volatility, they thrive. Oil, gas, and materials offer steady cash flow and a hedge against inflation, making them a safe haven when markets are unpredictable. All of these investors are trimming their exposure to sectors or companies they deemed overvalued or risky, specifically in the USA. Buffett's decision to cut his Apple stake, for instance, wasn't because he lost faith in the company, but likely to lock in gains and rebalance towards other opportunities. Similarly, Michael Burry's exit from US-based properties and bio-related companies reflects a broader caution about the domestic market's current state. Another notable trend is a pivot towards international opportunities. Burry's heavy bets on Chinese tech stocks like JD.com and Baidu, combined with Mark's increased holdings in Alibaba and other international players, show a willingness to look beyond the US for growth. With geopolitical and macroeconomic risks rising domestically, these moves signal a belief in the long-term potential of undervalued global markets. Want to know what Warren Buffett's advice is if the S&P 500 is returning just 3% over the next 10 years? Click the video on the screen to find out.